I'm going to show you a common way to hedge a portfolio, and then I'm going to show you what I believe is a far superior way to hedge a portfolio. And the first one we're going to show is a very common options trade on top of a portfolio. We're just going to simulate about $1 million portfolio using Spider stock, SPY stock, or the ETF, underlying ETF stock. And then we're going to throw on a covered call, which is a very common way for portfolio managers and investors to add income to their trading and give themselves a little bit of reward if the market sits still, doesn't go up a lot, or goes down. I'm going to show you a way that I think is vastly superior to that, while not limiting the upside and giving you a little protection if the market gets a little volatile and maybe even trades down over the next month. So first we see what I have on here is a simulation of 5,000 Spider shares at 208.67, and that's simulated here on this graph as a line, just a line that goes from the lower left to the upper right, meaning if the market goes up, you're profitable. If the market goes down, you lose money. And we have this date over here set that we can move forward into time and see how that changes. And you can see that if I go forward in time, nothing changes. That risk reward doesn't change. It just stays the same. So we'll come back to today. So we'll see often, and I have one more thing, these slices, they're called. So at 0, we have 0 P&L. So if we go nowhere, and if we go up 10%, we make 103,000. If we go down 10%, we lose 103,000. Very linear, very traditional. So what some managers and traders and investors will do is they'll come in and sell calls to offset their position and provide income. So this here is 50 calls because they're in 100 share increments. So we have 50 calls for the 5,000 shares, and they're $4.44 each, or $444 per share. And we can see now in this box right here, it shows you wherever I'm pointing, this risk reward will show, actually the equity curve will show up. White is today and red is at expiration, which in this case is just a little over 2 months from now. So you can see when I move, those numbers change. So as I point over here, you can go look back at that box and see that at expiration, this could generate 22,000 in gains if the market sits still. If it goes up a little, you actually have 23,700 in gains, and that would be just from a modest increase, just moving up just a little bit. Now if the market goes down 10%, and also have these slices here, so we can just kind of look at these, and this is going to show you as of the day. Now 10% move, you're going to get a max loss on those, not max loss on the calls, but you're going to be at your max profit and loss anyways, just about. So we can look down here as well. So we see 10% up, we can make 23,000. Let me pick it. 10% up, we can make 23,000. 10% down, we can lose 82,357. Now what happens is that is less than our loss could have been. So you bring in that credit and you lose less if it goes down. You make less if it takes off to the upside, but you get this income if nothing happens, if we just stay in the same range. Now, to some, that's a very attractive concept, and many people trade that. But I want to show you something that's a little more challenging. It takes a little bit more effort. You have to learn it. You have to learn how to do it. But once you do it, could substantially improve your risk-reward ratio, that you're not now setting up something where you can always make less than your potential loss, where you actually have a chance to have the same risk-reward up and down, and then also add income to the trade. So what I'm going to do next is I'm going to analyze out about a month and a half. So the end of next month, we can see what this is at. It's very similar. 81,000 potential loss, 23,000 potential gain if the market runs up, and you get 9,000 in income if we sit still a month and a half from now. So that's pretty good. That's kind of the idea of a covered call. Let's go back to today. And I'm going to take off this covered call again, and I'm going to go up here into the SPX, and I've loaded up a few options trades, and I'm going to show you what these look like. First one here is a butterfly. And this butterfly position Go back to today. This has been having a little trouble, so I have to sometimes reload it. So here's the butterfly position. You see this looks a little different now. Our risk reward is similar to owning the stock. So we can make a lot if it goes up, we lose a lot if it goes down, and just today, because we have some theta coming in, we can actually make a little bit on a daily basis. This is theta, or that's the income measured in a daily basis of the current trade. And so here's the SPX butterfly layered on top of that. You see, okay, now this is getting good. Let's go back to a month and a half from now and see what our scenario is. Our scenario is we can make $12,000 if we go nowhere, so it's a little more income. However, we can lose just a little bit more on the downside, but we don't have that limit of $23,000 to the upside. We actually have a much bigger upside. So we have some upside, we get income if we go nowhere, and we take on just a little bit more risk if the market trades down. But then we move into even more. So let's layer in a couple more. And it's doing it to me again. So I'm just going to load these up again and get rid of these. So I'm going to add 2 more options trades into this. And we mix these 2 in. And now let me go back to today. Back to today, if you see now, look at this. P&L on the day. So that means today. If today we were to go up 10%, we'd actually make more in profit than we would have without any of the options trades. So it's 103,000 without the options trades. This one's 110 if we go up. And then without the options trades, it's 103 loss if we go 10% down. And in this one, it's 90,000. So we've just instantly shifted the risk reward of our entire. We have now lose less if we drop 10%. We make more if we go up 10%. Wow. Now that's getting pretty good. So let's look at this too. Remember that theta number. Theta is positive income from premium decay and options. So we have a small amount. It's much less than if we did just a covered call. What you see is we also have income coming in. So we have income, more potential reward, less potential risk. So this is the kind of strategies that we look for and we set up for income position. So let's look at this. Now this is a month and a half from now, 7:30, just like the other one. To the upside, we can make 107. That's more than we could have made without any options trades. If we go nowhere, we can make 7,000. And if we go down, we can lose 103, which is only slightly more than if we did no options trades. And it's less than our potential gain if the market takes off to the upside. So it's often believed that to hedge something means you have to give up something. And that's sometimes true if you use a direct hedge. But when you use more sophisticated strategies, like this one here where we have to layer in a few options, you have to know exactly where these are. And this isn't just you just pull the trigger and you have this hedge. You have to know how to execute it properly. And every month you got to look in and see where's the best place to put it, what's my management strategy. And that's not even something I've gotten into, but there's management techniques that as the market moves, you can actually take profits from things. You can roll your trade to add more income and credit, protect more to the downside, take advantage of market movements. If the market trades down, you can roll the trade, lock in profits, reduce the cost of your hedge. So many things you can do. So I just wanted to give this quick example. It's a little bit oversimplified, but I wanted to just show you that owning just the underlying is one alternative. Hedging it with selling calls or another way to do it, we buy puts, is another thing to do. But we don't have to give up on income, and we don't have to give up the upside. There's other ways to do it if you learn the right ways